good afternoon, good evening to everyone. My name is Darius Liu. I am the COO and co-founder of ADDX, the world's first integrated issuance, custody, and trading platform for digital securities. And this is the latest installment of our educational webinar series. And I am so happy to welcome our friends from DLE AG, Nicholas, as well as Venetia, who are joining me in the studio today. Hi, Nicholas. Hi, Venetia.
Hello, Darius. Thank you for having us.
Welcome. Today's topic is a fascinating one, and it's entitled Introduction to Land Development, an Overlooked Real Estate Opportunity. Now, we all associate sort of land, real estate with buildings or sort of that sort of thing, right? But I'm sure you would agree with me after today's webinar that you have learned a little a thing or two about how you can use innovative strategies to unlock wealth creation potential in the area of land development. So I shan't steal the thunder of Nicholas and Venetia. I will go straight into the introductions. Now, Nicholas is the Chief Executive Officer of DLE AG Asia, and he leads DLE's Asia Pacific franchise, responsible for everything from expanding DLE's presence in this entire region to fund management, product development, investor relations, and fundraising. Prior to joining DLE, Nick headed up the Direct Investments Group Asia Pac at UBS. He had spent many years originating and distributing private capital market opportunities across a span of sectors: real estate, disruptive technologies, and impact and sustainable solutions. With me as well, Venetia. Venetia Lai is the head of investor relations Asia Pac at DLE AG Asia. And she's responsible for all aspects of investor relations and fundraising in this region. Like Nick, prior to joining DLE, she was part of the Direct Investments Group over at UBS AG. So welcome, Venetia. Once again, I'm Darius Liu, COO and co-founder of ADDX. I am very happy to welcome all of you to today's webinar. A bit about myself: before I founded ADDX, previously iStocks, I was with GIC for many years, looking at portfolio construction and asset allocation. And before that, I served stints in the government, including time at the Ministry of Finance. So once again, as your host, I welcome everyone to today's session. Now, today's session is going to be an interactive one. We like to make our sessions as interactive as possible. So there'll be a time of Q&A at the end of the session. Please feel free to post your questions, and the way by which you do this is to click on the Q&A button at the bottom of your Zoom screen and type in your questions there. At the end of the presentation, I will then pose your questions to our guests in the studio today. If you do not see the Q&A button, just move your mouse cursor to the bottom of your Zoom screen and the Q&A button should appear. Okay. Now, ADDX, as we all know a little bit about ourselves, is the world's first platform for digital securities issuance, custody, and trading. And we are very, very proud to give a wider audience access to world-class opportunities in terms of private market products, like hedge funds, like venture capital funds, private pre-IPO companies, private debt, and so on. So log on to your ADDX app to check out our latest opportunities. If you have not signed up for your ADDX app, today is your lucky day, because you can scan this QR code and we'll start you off with $100 $100 platform credit. We'll flash this QR code again at the end of the session, so not to worry if you have not time to whip up your phone and scan it. We'll scan this. We'll put this exact slide up at the end of the session. All right. So now, without further ado, I shall hand the time over to Nicholas to tell us a bit more about land development. Nicholas, over to you.
Thank you, Darius. Good morning and good afternoon to everyone. Thank you for joining us on this call. So land banking is a very broad sector. It's usually loosely defined as a real estate sector where an investor purchases parcels of undeveloped land, holding them with a view to an event or a catalyst, and then selling them at a profit when that event or catalyst occurs. It's usually a passive strategy, meaning one typically sits on the land, and the catalysts that most are waiting for are either inflationary or urbanization. This generally is a long-term strategy where one needs to be prepared for. Or in our case, which is land development, it's a subset of land banking. One could be active in this particular segment. And in our case, we're focused specifically on putting in building permits, thereby making the land ready for construction before on-selling them to developers. The strategy is in execution, a short to medium term by comparison. And of course, there are people who are in this strategy that work actively at rezoning land use. But again, this is generally a slightly longer term strategy, and is typically better suited for strategic investors than financial ones. For us at DLE, our focus is primarily on the permit processing business. Our model is straightforward. We limit zoning risks by acquiring land within master zoning. The slide on the right is where you see some of our sites. And you can tell from this that it's located primarily within the master zoning that you see on the left. We then take the slide through a rules-based building permit process with the land authorities. There are basically two different routes, one involving a development plan that you see on your left, and section 34 that you see on your right, which is a straight application for the building permit. Plots involving development planning generally takes a little longer than those who don't. We typically underwrite plots in this segment that take no more than 3.5 years to permit. Under section 34, the timeline to permit is somewhere between 6 to 12 months. We then auction off the land to developers when the permit is close to or in place. Sometimes we enter into forward purchase agreements with developers. And to be very clear, we do not develop, even though we have development expertise. This way, there is no development risk in the strategy, and we are not relying on building completion for our exits. We do not use leverage. This is an all equity business. In Germany, conventional bank financing is not available for land without a building permit. This, in fact, is actually one of the drivers behind the opportunity, which I will go into further later, but for now, know that the strategy is unlevered. So at DLE, we've been in this business now 6 years, longer if we were to include activities before we formalized DLE. DLE was founded by Rainer Shaw and Yolanda Schmidtke, and is today managed by the faces that you see on this slide. We run 3 businesses, namely land development. At the moment, we are one of Germany's leading supplier of building-ready land, and that land is applied primarily into the affordable housing sector and the commercial office spaces. Residential forms approximately 3/4 of our business. In property management, we are engaged in the senior living and in the light industrials and logistics space. We are very quickly going into new strategies, including data centers. We are also engaged in financing property development. We operate mainly in Germany at this point, but we aspire to expand into other regions, starting with Poland. Now, naturally, we couldn't have done all this in such a short time span without the support of our partners. The key ones you will see on this slide. So what drives the opportunity set? So firstly, Germany remains the powerhouse of the EU. That in turn has drawn people into the country in search of work and a better life. That's actually one of the key reasons behind why residential demand has remained strong, increasing, in fact, in prices by approximately 15% year on year through COVID. Equally, commercial office space has remained resilient despite the headwinds. with average vacancy rates remaining low, sub 4% nationwide. Now, Germany suffers a housing crisis, much like most parts of Europe. At this point, there's approximately 600,000 units at any point in time that's missing in the middle income and social housing segment. 200,000 approximately of that is in Berlin alone. So for those reasons, vacancies have remained low at a sub 2%, with supply meeting less than 3/4 of the total housing demand. That in turn has been driven primarily by the long-term themes of urbanization, where people move from tiers 3, tiers 2 cities to tier 1 in search of work and a better life. Immigration is the other big driver. Germany takes in on average about 500,000 net new residents per year. That works out to be approximately 6.1 persons per 1,000 population. And for guidance, Singapore takes in maybe roughly about 4 per 100,000. And so on the back of that, we expect the sector to remain well supported, especially in view of how wide residential spreads have become vis-a-vis the Bund. So what we're doing here has a real impact, because macro aside, there's a real dire need for new residential builds, which cannot happen unless you have building land. So if this is not handled well, meaning the lack of supply of building land, it can lead to unsavory displays of social unrest, as we've seen in some countries. And so we at DLE, we take ESG very seriously. And through this strategy, we believe that we are improving lives and human capital through the strengthening of basic infrastructure. The commercial space is the other area that we're involved with, although it's a smaller part of our business. It's unclear still at this point, what the outcome and the impact of COVID will be. But what we do know is that whilst people like the option of working from home, we also know that they don't want that to be the only option. And I'm speaking I believe I'm not speaking just for myself. So vacancy rates for German office spaces are low historically, and have continued to remain low through COVID. This in turn supports yields in prime commercial spaces of a low sub 4%, as I had mentioned earlier on. The capital investments continue to pour into the sector. Last year alone, some almost 60 billion euros worth of investments poured into this sector, and it's almost as large, if not larger, than those transacted in the UK. And obviously, with all that capital flowing in, it's pushed up prime rents, despite the stats indicating that some of the take-up rates have come off just a touch last year. Now, ask any developer or economist why the situation is such, and you will invariably come to the same conclusion, and that is the shortage of building land, which begs the question, why? Now, we think that is driven by a few things. Fundamentally, there's limited bank financing available for the purchase of land that doesn't yet have a building permit in place. This results from a banking law with origins dating back to the 1800s. And in essence, by regulation, banks cannot extend loans against land that don't yet have a building permit, effectively rendering them illiquid. The natural buyers of these plots, which would be the German developers, are, by comparison to Asia, thinly capitalized. The market cap, for reference, of the 3 largest developers combined are just circa euro 3 billion. In comparison, once a permit is in place, residential development financing becomes readily available. So even for those developers who are willing to fund land purchases with all equity or alternative financing, which are generally quite expensive, Given that financing for development projects at attractive loan to costs ratios are accessible, most come to the view that the equity is better used in the quick turning levered residential development projects, as opposed to committing the equity into getting the permits in place, which can take, in our case, it takes somewhere between 2 to 3 years. So the net result is large mixed-use plots in particular that do move the needle in the supply of building land have limited suitors who can and are willing to acquire and work the permitting. And that, I believe, is the solution that we at DLE provide. So, in closing, land as a strategy is one of the oldest plays in the world, and it should, we think, form a part of your portfolio. Now, it's worth understanding this sector, but recognize that it differs across jurisdictions. We are 100% German. The strategy works well there, but for reasons discussed, it's not likely to work in, for example, Singapore, or indeed even in Austria, just across the border. The strategy doesn't work there. But regardless of geography, when it comes to strategy selection, we advocate the following. So firstly, invest alongside institutional investors. Nothing speaks stronger than a proper LP advisory committee comprising institutional investors, typically pension funds, insurers, sovereign wealth funds, that manage capital for a living to oversee progress and monitor risk. Secondly, that the strategy carries limited zoning risk. Thirdly, that the strategy carries no development risk, meaning that you are not relying on the sale of a completed building for your exit. This is a very different proposition from everything that we're discussing here. Fourth, that the strategy is unlevered, meaning that you are not relying on any debt to complete the acquisition of the land plot. This way, you remain senior in the capital structure, and that's the best way to ensure your downside protection. And lastly, manage your track record. And I think this point doesn't need a whole lot of explanation. It speaks for itself. And with that, I'd like to hand it back to Darius for Q&A.
Thanks, Nick, for the overview. Once again, before I launch right into Q&A, because I see all the questions really pouring in, I just want to make sure that I cover all of it. If you want to ask any questions at any time, just mouse over to the bottom of your Zoom screen. You should see the Q&A tab signified by 2 speech bubbles. Click on that and input your questions right there, and I will address them in turn. All right. Nicholas, all right. So one thing that I learned right from talking to you before this and through your presentation is that the strategy that you have outlined is there's certain details that are important to understand, right? So, like for example, you don't take on zoning risk. So unlike some of the others, I recall some other land banking outfits that have imploded in the past. That is really one of the key distinctions. However, of course, with every good opportunity comes risk. So in this scenario, in the strategy that you just described, how would an investor possibly lose money? In other words, in which scenario would the strategy underperform?
Sure. So if I were to break it down in parts, and this is going to sound a little bit rudimentary, but like all things, when supply outstrips demand and prices drop, potentially you could be losing, taking a hit on your principal. But let's consider what could possibly lead to that. So on the supply side, at this point, 600,000 units short in the affordable housing space. And for reference, Singapore HDB inventory stock at this point is about 1.3 million. And I think it took us something like 40 years to build that. So I'm not, never say never, the ability to fill the 600,000. In fact, the ex-Chancellor Merkel, one of the things that she was advocating was, I think she had handed down a decree to build something like a million units within the next 2 to 3 years. So there's a real push behind filling it, but it's not something that's likely to happen overnight. And indeed, I mean, if you think about it, 600,000 units, each dwelling on average in the affordable housing sector is approximately 100 square meters. That works out to be about 60 million square meters GFA. And for us, after the years of being in this business, we're just touching 4 million, right? So, you know, the penetration that we have in it, and we're not the only ones that are doing this, but hopefully it gives you an idea on the supply side, how far we are away from that point. On the demand side, you know, obviously, you know, like I mentioned earlier, this is driven by urbanization and also immigration. Now, both of which could stop, or you could potentially have a huge outflow of people from Germany. But again, I can't fathom, you know, any reason that I can think of at this point that would drive that. Yeah, so I think in terms of the things that could cause the, you know, any strategy in this sector to result in a capital loss, it's driven, you know, largely around the macro side of things.
All right, thanks. I wanted to just bring the conversation back to the point you raised about this strategy being an unlevered one, right? And those of us who are in investment circles typically associate leverage with better returns, right? Or you juice up your returns using leverage. And here I'm hearing that this is an attractive strategy and it is by design unlevered. Now, so how do I square that in my head, right? Maybe you can help me with that.
Sure. Look, I wish we can take leverage. There is, don't get me wrong. But the banking regulations are such, you know, in the areas that we operate, you know, you're not gonna be able to mortgage the land for any kind of borrowing. So at the fund level, at the business level, if we wanted to take leverage against the land plots, we cannot. And from the investor's perspective, that's a good thing, because it basically means that you are senior in the capital structure. If the permitting process, which is very rules-based, if for whatever reason they get held up, you're not going to be faced with a situation of a liquidity crunch where you're going to have somebody senior in the cap structure come knocking at the door saying that I want my money back. Sorry, you're going to have to sell this thing at 50 cents on the dollar just for the recovery. So yeah, that's so for you to square it in your mind, it's not that we don't want to, it's just that we cannot. But then by the same stroke of the same pen, it's this particular restriction that's creating this this opportunity set for us.
Very interesting. Now, given the attractiveness as you painted of this strategy, obviously good returns will attract competition. But as I look around and do a bit of research in this space, I don't see many competitors. And why is that? If it's so attractive, why aren't other funds sort of rushing into this space?
Yeah, that's a good question. Now I cannot answer for everyone that's in the space, but suffice to say that there are actually not that many players specifically that's in. So by players, I mean asset management groups that have institutionalized this product. Now this excludes family offices, you know, individuals, developers that may, you know, opportunistically acquire a few plots here and there, mostly for, you know, either speculative purposes or for strategic reasons in the case of developers, right? So speaking just purely on the institutional side of things, one of the things that's become clear is that, you know, from a, you know, in particular, if you are a large asset manager, the business that we do is resource intensive. By that I mean people intensive. So for some of the incumbents, the AUM and the fee per employee consideration may not commensurate. And in a way, that's a nice barrier for managers like ourselves that are specialized in the space. And again, to put it in context, we're pioneers in this business. We're leaders in this space, but that doesn't mean that there won't be other groups with similar DNA like us appearing on the scene. And we welcome that because, as I mentioned earlier on, at least 60 million square meters GFA of land needed to fill the gap. And we're barely 10% at this moment. And we truly believe that, by doing so, we are resolving to improve lives.
And in the investment process that DLE has put together, or in land banking as you described in general, how does one go about originating or sourcing deals or parcels of land? Right, what do you look for, and how will you put in place a process that gives you an edge on that?
Yeah. So I don't want to be the only person speaking here, so I'm going to let Benicia take this one.
All right, I'll take it. So maybe I guess the question's around how are deals typically being sourced. I'm not entirely sure about what it's like in the other markets, but specifically to Germany, the typical sellers of such land banks can be from inheritance groups, the Jewish repatriations, typically because of the history where they are granted land. And so they are typically represented by law firms that would like to monetize the land bank or land bank that they have that's given to them. The other kind of sellers of land banks are actually corporations who own the real estate, but main business is actually not real estate. So, for example, grocery chains or supermarket chains in Germany that actually is sitting on real estate, and then the real estate they're sitting on is now zoned, let's say, residential in the neighborhood. So they do need to look out for real estate partners to kind of get the building permits for the developments. So these are actually a range of sellers of land banks that you can source in Germany.
Okay, thanks, Benicia. On this, on a related note around acquisition of plots and so on, were there any sort of negative case examples, not necessarily DLE, but in land banking in general, where either the land could not be eventually sold or sold at a significant loss, or the building permit process somehow didn't turn out? And the second part of the question is, how does DLE sort of think about managing those risks?
Okay, maybe I'll just start off with kicking off with maybe on the permitting risk. So in Germany itself, it's actually very clearly defined in the Federal Building Code on the process of obtaining a building permit. So as long as we follow the rules or the stages of the building permit defined in the Federal Building Code, and we don't do any rezoning, the permit is actually guaranteed in Germany. And that's stated in the Federal Building Code there. So there, in terms of permitting risk, if let's say in the master zoning scheme, this plot of land is now zoned as condominium, and we follow the exact steps of what is required to get the building permit in the building code, we will get the permit. I think the only uncertainty in that process is really just mainly time in terms of the permitting risk. And I think you mentioned about how DLE, could you just repeat the first two questions?
Yeah, and then how DLE sort of thinks about sort of mitigating the risk that I mentioned, right? So one of them is, of course, the permitting risk. Then the other one would be, for whatever reason, the land is it couldn't be sold after a significant period of time, or sold at a loss, for example.
Oh, okay. So I think the permitting risk portion has been answered. In terms of whether DLE has actually sold it at a loss, clearly not in our funds. I think there were a couple of examples that we have earlier where we were doing typical club deals to try and fine tune this asset class as a fund, that it was difficult for us to kind of exit the plot. So for example, one of it we wanted to do was more agricultural land, zone agricultural land into, let's say, residential development. And what we found down there was really that the time taken to get the permit was actually really very long, longer than expected. So what we learned from there pre-setting up all our funds is that for the funds that we manage, it's only buying urban lands that are zoned in our master zoning scheme. that we will undertake, and we don't do any rezoning play. So as what I previously mentioned, as long as the land is zoned residential, for example, where we follow the permitting scheme on the building code, we will be able to get the building permit before we exit it out to the developers.
Zoning, if the strategy is simply all just zoning, meaning if you're driving the value primarily from turning what is typical, agricultural land into some other use, that is the main strategy in itself. That's one that is difficult to institutionalize. Now, it can happen, but it's likely to take a very long time, and that's very typical of the land banking type strategies out here in Asia. But again, to be very clear, the business that we are engaged in is actually, it's actually quite a boring business because it's primarily permitting. And as Venetia had mentioned, the key thing that is out of control for us is the time. And it's not so much about our time; it's more at the processing end. I have to choose my words carefully here because our partners predominantly the federal related land bureaus, but the workload is immense because of this particular problem, and it's been known for years that particular part of the government needs more resourcing. And I would like to think that, with the elections, and of course, there's now over the next few months, we're talking about, the forming of a new coalition, et cetera, et cetera. But one of the key things that are consistently tabled is around new bills, and tied to new bills, it's about the application and the approvals of new building permits, and tied to that is around increasing the staffing and the resourcing of that. So that particular element is what creates the uncertainty. And also tied to this, and I don't want to segue too far from this, but when you look at the overall funding structure of a new build, so on average, just taking Hamburg as an example, a very typical middle income unit over there will run you approximately 7,000 euros per square meter. We're purchasing our land at around about 10% of that overall cost. Now, as long as it's within the master zoning, which is the one of the key criteria in the land plots that we underwrite, you kind of have to think, will the price be zero? Again, never say never, but I think it would take a relatively extreme scenario for that land price to be absolutely zero. And as you move through the processing, each particular gate that you go through, the valuation of the land plot goes up, and it's very clear. It's a matter of public record. Now, the fact that there are people who simply buy the land, sit on it, and wait for the inflation, and again, in the last 10 years, if you've been involved in the sector, you've been making money, and I wish I was, but you would have made money hand over fist. But the point I wanted to make here is, even if we bought it, did nothing to it, so purely speculative, waiting for just the market prices to go up, that gives you the buffer, which addresses the question of, if I were to sell it at my entry point to get out, can I? So far, the data points would indicate, yes, there's a good probability you'd be doing that. And that's assuming you did nothing with the land, but we actively manage it. And you kind of have to think that if you are 50% through the processing, then surely for you to get out at your entry price to the next buyer, knowing that you've gone through halfway, that surely must be an attractive proposition for some. And that's how we look at the upside downside.
Okay, thanks, Nicholas. I just want to double click on the part where you exit each proposition, right? So does DLE, or typically the funds that subscribe to this strategy, do they have strategic partners, buyers, developers, what have you, lined up already, right? With a healthy pipe, so they give you some certainty around that. Yeah.
Sometimes we do, sometimes we don't. But again, there are past transactions where state-owned developers come in, In fact, they are the ones that brought us access. But the condition is that we need to have usually about 30% of, and this is market practice, 30% of the land needs to be slated for social housing. And the moment the plans go through and it's carved out, even though it's still in process, they tend to do forward purchases for these plots. So short answer is yes, to the extent to the extent it's conducive for the returns. And again, it's always in the price, yeah. Because if somebody does a forward purchase, then clearly there will be conditions around how the design would run. And if we're going to be, submitting processes that is specific and it's, built for purpose for one, then obviously that needs to be in the price as well in the underwriting.
Mm-hmm. And for a typical investor into this fund, what kind of returns would he expect to get, right? Over and over what time horizon?
Sure. Sorry, I want to get some guidance here. This is meant to be an educational.
It is, yeah. So not maybe in DLE in particular, but let's say, for example, funds in this space, right? Generally, maybe you can give me a range or some kind of a guidance. Is it 3x? Is it 10x? Is it
It's well, look, I mean, it really depends on the risk spectrum that you're in. I mean, if you're taking agricultural land and then looking to do the whole change of land use kind, then yeah, I would think that return needs to be a lot higher than the kind of returns that we typically look for. And so it's a range. There is I hand on heart, I can't really tell you because I don't know in the institutionalized fund management space in this sector. There really aren't that many. And for those individuals that do get engaged in the highly speculative strategies, if you ask me to venture a guess, I would say that it needs to be at least about 3 times or more in terms of equity multiples, because for us we are already generating those kinds of returns for the larger plots, and we don't take on those kinds of risks.
Thanks. Who are the sort of this is obviously not something that is very well known, at least not in this part of the world, at least, right? This land banking strategy. Where do you see the source of monies coming into such strategies? Are they generally from sovereign wealth funds or other sources of capital? Where do you see the money coming in from?
Right. So this is speaking specifically just for us because I don't know about the other groups. So at this point, we are approximately 50% in institutional capital. The other balance 50% comes from large family office groups. And at this point, we are approximately 3/4 European, and then another quarter that's Asia, and that's the right kind of mix. Because if it was skewed the other way, it would be, to me, that would be a red flag. So the fact that we have strong local European, German, Austrian in particular, insurer and pension funds that are anchors in our fund that sit on our LP advisory committee, that should provide the balance and the comfort. And so to answer your question, we're still very European. Now, naturally, we're building branding, out here in Asia, and in particular, we're looking to do that with the institutions in this region. So over time, we should see more of it balance out. But remember, we're not just simply doing land development as a business. We do run other fund strategies as well.
Just changing tack a little bit here. So you talked about things like affordable housing, that sort of thing, and the transition away from Merkel to the new PM. Now, that obviously with any transition comes political uncertainty and sensitivities around such things, right? So what would be the sort of upside and downside scenario for your strategy or strategies in land banking in general in Germany around such things?
Yeah, Darius, I mean, it's always dangerous to discuss politics in any segment. But suffice to say at this point, if you read the rhetoric in just about all of the, all of the different parties, is it going to be, red, green, whatever, right? But the rhetoric is new builds. We need to have them. And so it speaks well for us. The coalition will form, but in the meantime, until it forms, the challenges that I mentioned earlier on, meaning the mountains of applications and the speed of the processing, that needs to run its natural course. So the short answer to your question there is, and I'm not doing this to avoid, just discussing thorny issues, other people's politics.
To the extent you can.
Yeah. So if you read any of the rhetoric of any of the parties, it's driven around new builds. Even the rent cap of past, which by the way was you may have seen, it was deemed unconstitutional. It was lifted, but that. I think what was not widely known was that it applied to buildings before 2014. So again, it was driven, fine, it's election year, so you need to be seen to do something to solve the problem. So let's try to do something, but not impact the most critical thing, which everybody knows, and that is new builds. So what we saw coming up from the rent cap was that we had landlords that said, okay, look, if it's going to apply to old ones, the older ones or the older vintages, let's not spend any more money retrofitting or refurbishing some of these ones. Let's just focus on the new and in particular the new builds. So again, it kind of funneled businesses more flow towards us. Okay.
You mentioned in your presentation that this strategy that you described works well in Germany. It potentially could work well in Poland, but not in other jurisdictions like Singapore and all that. What makes certain jurisdictions more amenable to such things than others? Right. We have a couple of questions around that theme.
Sure. So you need three things for this to happen. Firstly, you need to have banking regulation that says you cannot mortgage land with no building permit, borrow and buy. Secondly, you need the developer space to be thinly capitalized. And so, without mentioning specific names, but if you pick any of the developers in this region, they are so balance sheet deep that if a white site comes up, is there a problem in taking it down? And the answer is no. And so if you don't, and of course the third element is that financing for development projects is readily accessible. In Germany, this may shock some, but at the height of things in the residential affordable sector, a developer, obviously your credit standing and all that needs to be good, reputational and all that, but you could get up to 100% loan to cost, which basically meant you didn't need any equity in the projects. Lenders were happy to do it because, well, firstly, the demand is there for every new unit that comes up. It's liquid. It just disappears. And then the construction of affordable middle-income housing is not exactly complex. So if any developer would run the trouble to have somebody else step in and do it, that's not a difficult. That's not a well, I want to say it's not a difficult proposition, but that's not being fair. It's what I wanted to say is it's not an impossible thing. In fact, it's compared to, say, for example, something that's complex like a wafer fab plant. By relative to that, it's a lot simpler. So these three things combined creates the opportunity set. If you have one or two of these things missing, or in fact just one of these things missing, it's very hard to replicate the same strategy. So I guess what I'm saying is that there's an arbitrage, and it's created by regulation, and also to some extent capital.
Interesting. Now, for funds that play in this space and according to this strategy, what would be the typical life cycle of it, right? In general, one would imagine that in private markets there will be a closed-end J curve type dynamic going on. What would a fund like yours or players in this space look like?
Okay. I think again, I can't. I'm trying to balance out, speaking like generically.
Or like generically, a typical life cycle of a
Yeah.
land banking fund, right? What would that look like? Yeah.
Sure. So I think generically it's no different from any closed-ended blind pool, private equity or real estate fund that I'm sure our callers are familiar with. In the off chance that people are not, closed-ended funds are funds with a finite lifespan. Typically that would run 7 to 10 years, after which assets are sold, capital return, profits are shared. The blind pool element means that the LP or the investor has some idea of what the pipeline is, but you don't really know until the manager actually pulls the trigger. And because deal execution in this kind of a setup requires gestation, capital is called over time and deployed over time. And that in turn leads into that dreaded J curve, which is industry speak for the initial period of time where returns are negative. Now, okay, I think that would be the typical landscape. But occasionally you may come across a short-dated, close-ended, non-blind pool situation that deploys all your capital upfront. These are rare, and I think when it comes up, one should pay attention and look at how it's done.
Very interesting. Now, I have an interesting question here. I should just read it out verbatim, right? How can investors gain comfort in the legitimacy of the land investments? By that, it could mean the provenance of the land, the legitimacy of the land titles, or the legitimacy of the manager managing it. I'll leave that to your interpretation, but that's the question.
Legitimacy of
the land investment.
The land. Okay. So, well, if it's the land, it's a matter of title. And again, this is why the master zoning is important, because when you go much further out, given the history, it's sometimes land title much further out into the woodlands is unclear. At some point, it belonged probably to royalty at some point, but all that's lost. The records have been lost, through time, the war, and all that. So legitimacy around the land titles, if it's within master zoning, that can be verified. Legitimacy around the manager. So I think that's a fair question. And I think, again, it falls back on the hallmarks of what makes, not just in this strategy, but any fund manager and in their strategy. And it's some of the things that I mentioned earlier. Are there institutional investors in there? Who are the institutional investors? Who makes up, do these institutional investors make up your LPAC advisory committee? Certainly for us, I had mentioned in one of the slides earlier, Allianz is our anchor. They are on our advisory committee, and we speak every quarter. Because for us, we mark our we mark our business, our fund every quarter, and so that proves it up. Now, Darius, leading up to this, you had mentioned to me, some of the names of things that had blown up. I must profess, I don't know them intimately. I don't know the groups. I've read the news wires that you sent me. The one thing that does stand out to me is when you look at the investor base, it's predominantly non-institutional, and it's usually strategies involving a very high element of zoning, rezoning, and speculation. But again, I don't wish to speak out of turn because I don't know the strategies there intimately. But those were the things that jumped out at me. as I read some of the things that you pointed me to.
Well, thanks. This is an interesting one. I'm not sure if it's within your realm, but I'll just pose it anyway. Are there any restrictions or limitations imposed on new immigrants buying residential property in Germany?
New
immigrants.
Like here, where if you're not PR or citizen, you can buy HDB.
That's right.
No.
Oh, okay. Well, that's good, I guess, right? For the demand.
If you're citizen, yeah.
Okay. Well, I guess by new immigrants, it would mean citizens. In this context. Okay. Let me see the list of questions. We still have many, so I'm just trying to triage this. What would the sort of typical land size transaction and the number of plots within a archetypical fund, right? It doesn't have a DLE, but like in general, and so to get a sense of like how concentrated some of these strategies are.
I'm not quite sure how to answer that one because it would have to be, well, first of all, there's no average because each fund is all slightly different.
Yeah.
We are the only one that's in Germany that's operating at an institutionalized manner. So maybe
I'll put the question another way, right?
Yeah.
Is it a very concentrated, high conviction type strategy, or is it a more sort of broadly diversified in the sense of there are multiple plots that sort of drive that return on average?
Again, specific to us.
Well, in general, or in the strategies like this, right? What would be the correct way to think about that to make this strategy work?
I think if you ask any manager, they would say, yeah, it's a strong conviction trade, which is why we're doing it. I can't imagine a situation where a manager goes in to underwrite something and says, yeah, maybe this is a 50-50. So I think I'm not sure how to answer that question in a generic fashion. But what I can say is that for us, in the underwriting, there's a lot of pre-underwriting work that goes in, key of which involves socializing the plan with the approving authority. And so once that's been agreed in principle, the work starts in terms of the underwriting. Because how it's designed, how it's laid out, how much green space, for example, determines the commercial viability of that plot in our next buyer analysis. And if it doesn't hit targets, then we don't underwrite it, because it could mean that either the pricing is too high, right? Or the eventual sale price is not something that we think we can get to. And again, so I think I understand where the question is coming from, but I can't speak for other managers, but that's certainly how we do it.
I do have a couple of questions here around sort of downside scenarios. Now, you've touched a little bit about that in the earlier question, but I guess it judging from the volume of questions I'm getting, bears repeating some of the points. So, for example, in a sort of global macro downside scenario, for example, right, how would a fund like this fare? And conversely, in other sort of macro scenarios.
Okay, Darius, can you help me out by maybe saying a specific macro?
Like, I mean, GFC, global financial crisis.
War, then, yeah, everything's off. But
okay, how about 08, right? Something like 08, or maybe that would be a one useful scenario.
Well, how about something more recent, like now, what we are seeing?
Euro crisis, maybe.
Well, nothing's worse than what we're going through, which is the corona.
And how would a scenario like how would a strategy like yours sort of be expected to fare in such a scenario?
So look, I have to admit, at the height of things, I was personally quite worried. But as more and more, so we have first quarter numbers, second quarter numbers on the macro, in terms of what are residential prices doing, what are vacancy rates doing, and all the rest of it. I didn't really want to believe the numbers until we had a good solid year. And so, after 4 quarters, the indications are clear. The affordable housing segment, which is where bulk of our land plots feed into, that hasn't come off. It's if nothing else, it's actually gone the other way. 25% or so of our business is in commercial. Now that honestly is unknown at this point. Vacancy rates in the office space nationwide has ticked up a little bit, but in context, it is still extremely low by any measure. We're any given day, 4.5%, 4.7%. Singapore, last I looked, is more than double that. But you don't see people panicking. You don't see people. People are unhappy, but you don't see landlords panicking, about commercial spaces and all the rest of it. In fact, we just had a nice discussion yesterday with a relatively large group, and they are still looking for commercial spaces as and when they come up, specifically, around certain key gateway cities, etc. So yeah, it's good to talk about macro, but it'd be nice to kind of cuff it to exactly what. And I hope I'm able to answer that question by pointing to something that is like what we're currently going through at this point.
All right, thanks, Nick. Okay, we have quite a few questions, but I'm conscious of the clock. We're just coming up to the top of the hour, so I am going to pose one last question to Venetia and Nick. Are there any plans for DLE to launch a strategy like that in Asia? Are there any Asian jurisdictions that are, amenable to this? Obviously, you two are here for a variety of reasons, and maybe you could give us a bit of a preview into what you guys are thinking.
For land banking specifically,
that's right.
Okay. Because the ingredients that I mentioned early on, they're not here. But the other strategies that we run, in particular, senior living, light industrials, and logistics, those are certainly sectors that we are looking at closely. And to take a step back as a group, we're a platform, and we're growing very quickly through the partnership with best-in-class fund managers from within the industry. For them, we present an opportunity where they become a business owner of their own strategy, which for most of them they were basically the engine room that's buried within a large organization, and that's how we're growing as a group. And those two strategies are indeed very interesting, and it's something which we hope to be able to bring and or replicate out here in APAC.
And I'm waiting with bated breath for those developments. And on that note, I am conscious that we are just about at 6 p.m. So thank you very much, my two guests, Nicholas and Venetia, for gracing the studio today and sharing with us this fascinating topic on land banking. And on that note, I would like to ask my team to put up the slide that shows the QR code, for which you can avail yourself to $100 of investment credit on ADDX if you sign up via the QR code. So I'll leave that slide up as I end this webinar. And once again, thank you very, very much for joining us today. Until next time, until the next webinar, I'll see you soon.